On today's video, I talked to you about my first 4 stock investments, including one that's made me over a 500% per annum return and one that I lost half my money on. Hello everyone, I'm Ethan Ruschalek, and on today's episode I'm going to talk to you about my first 4 stock investments, why I made them, why I got into investing in the first place, and what my overall strategy was when I began and how that's changed over time. So my first investments I made was in December 2017, so I was about 23 years old at that time, and I decided to split my funds into 4 different stocks. My overall aim was to learn about the stock market rather than make lots of money off this initial investment. I just wanted to have a good understanding about how things work, and I figured the best way to do that was actually put some money on the table rather than just keep researching things. So I did a lot of research initially on YouTube, articles, etc. And I also was in a financial position where I didn't have any major consumer debt like credit cards or Afterpay or anything like that. And so therefore I felt like I had the funds ready to actually put some money down without being stressed that if I lost it all, then it wouldn't be a major financial burden on me. Alright, so the first stock that I picked was actually my best one, and it's been my best one overall by far. So I actually invested in Afterpay when it was $5.09 a share. So this is going to be pretty insane for people that now know that Afterpay as at this time is up around the $95 mark. And as you can realize, when I got it for $5 compared to $95, I've made a huge capital gain on this. Now, obviously my initial investment wasn't huge dollar-wise, but percentage-wise, it's returned over a 500% return per annum, which is just insane when you think about it like that. So this was one of my 4 investments. So this was the one that I wanted to buy a company that was already solid. So it wasn't a penny stock, but it wasn't a known name Australia-wide. It was still growing at that stage. So its share price had started to go up a little bit when I got it, but it wasn't huge and it hadn't grown massively. So when I get an initial investment like that, I don't want to go pick something that's grown 500-600% over the last couple of years and then isn't going to be able to sustain any growth because I might have missed the boat. With Afterpay, I thought I'm getting it at a price point where I think it's got a lot of potential to expand. So the reason I knew about Afterpay, I'd actually started offering it in a small business I was running. So that was where my knowledge of the company come from. And I just like the fundamentals of the company. I like the idea that it was interest-free to customers. I thought that's a great way to grow their business because it's not going to cost the customer anything. And stores are going to offer these services. I thought it just made sense for stores to offer it. So at that stage, not many were doing it besides a few online stores, but they were starting to talk about bringing it in-store as well. So I just thought this has a huge potential for growth. And then when I got into it, they quickly started then to expand into overseas markets like the UK and America, and this just exploded the share price. Now I did sell some of this along the way because I thought, wow, this is becoming too big a portion of my portfolio. Obviously initially it started at 25%, but due to the huge growth, it started to take up too much of my portfolio. So I sold at price points where I didn't know whether it was going to continue to grow at that rate, which sometimes it did, but I've still kept the bulk of my investment. So Afterpay has been an interesting one over the last 12 months navigating through COVID. So initially the stock price fell to about $10 or $11 a share. So while I had lost obviously a lot of the gains I'd made, I'd still doubled my initial money. So then with the money the government in Australia has poured into, especially those who were really struggling, who'd lost jobs and stuff, they've managed to give them enough income that they've still had disposable income. So obviously Afterpay's market is aimed at disposable income a lot of the time. So it's aimed at people spending on money on clothes, on other retail things that are more throwaway purchases. And this has been able to continue, whereas initially the market was thinking it wasn't going to continue. So because it has been able to continue, the share price has actually grown crazily over the last 6 to 12 months, and it's now at such a high point. So Afterpay has been a really good purchase for me. It still takes up a little bit too much of my portfolio for my liking, but because of the growth, it's mean my portfolio growth has been really solid. So my second investment was the worst one, and that was Digital X. So they were a cryptocurrency consulting company as such. So they helped with launching coin offerings, etc. So I'd actually done a few little investments into cryptocurrencies themselves. So I was naturally interested in the companies that were on the stock market in that space. So this was, again, at that time where crypto was exploding, but this time I got in too late. So what happened is my shares actually did grow really quickly initially, and I think they almost doubled in value in the first couple months. But then when the crypto market dropped, they dropped dramatically, and I should have got out then. So instead I held and held and held thinking it would bounce back, and it never did. And eventually I decided, you know what, this investment's going nowhere, and I cut my losses. So I lost about half the money I put in. So I think it went down about 53% in total. So I think this is a poor investment purely because I already had investments in cryptocurrencies. So I think I then was exposed to cryptocurrencies which really were a high risk investment that I don't think I needed both. I probably could have just invested either in cryptocurrencies or in this company, not both. So it was a lesson I quickly learned that you've got to make sure you've got that diversification, because otherwise if things crash, especially in a speculative thing like crypto, then your investments are going to crash pretty quick. All right, my third stock pick was Telstra. So this was the first of my 2 dividend stocks that I wanted to get into. The reason I did this is, again, I was trying to learn the market. So I wanted to have some dividends just to get that better of understanding of how companies go about increasing or decreasing their dividends, what the yield is going to be, how the growth of a dividend company compares to something that doesn't pay dividends. So I went with Telstra. I've always used Telstra. They're the biggest company in Australia when it comes to telecommunications, and I just thought it's going to be solid. Their price had also dropped in the last 12 months before I got this, so it was at a price point I was happy to get. So overall, I've actually slightly lost on Telstra, only by a couple % per annum, but that's been because the dividends, while they have dropped a bit, they've still been solid because I got it at a decent enough price. The capital gain has gone down about 8% per annum, but then the dividends are about 7% up. So you end up coming out almost square. So I don't know if I would do this again. I'll talk about it in the next one as well, but I don't know if I'd go for particular dividend stocks now. When I'm picking individual stocks, I'd rather go for growth stuff. And then when I'm looking at dividends or those more solid long-term blue chip stocks as such, I'd rather go for probably an ETF that just gives you that broader range of dividend stocks and non-dividend stocks, but that broader market range that I think is better than just picking one individual company. And then so the fourth one was NAB. So again, similar to Telstra, I went with a company I was familiar with. So I wanted a banking stock. So I looked at the big 4 banks in Australia. I ended up going with NAB because there wasn't a lot of difference between the 4 banks overall. And NAB was who I banked with. And I thought out of all of them, from what I looked into, they looked like probably the best investment. Again, it hasn't been overly great. I've lost out slightly on it. The dividends have offset some of those capital losses. But obviously, especially over the last 6 to 12 months with this virus stuff, is banking stocks aren't as attractive right now purely because the strain that's going on household budgets puts a strain on loan repayments, and then that obviously increases risk for banks. So again, I probably wouldn't go this option again, but I think it was a great way to learn and just get those dividends coming in and just getting a better understanding of how dividend stock works. So overall, you can see I've made good money off these first ones, but that's been mainly weighted to one particular stock pick. But I think it was a great way to do it. And I really recommend that a lot of people look at a strategy like this as a way to just learn about the market. The best way to learn about the market is to invest in the market. You're not going to learn the same by just, I'm doing a calculations on what I would have invested in, and just put some money in if you think about doing it, but don't ever invest more than you can lose. So don't put $100 or $1,000 in if that's important to you and that's your emergency funds. And do your own research. What I've done doesn't suit everyone. It's just a way that I've done it, and that doesn't mean that it's going to be perfect for you. So don't go with too many speculative options, but at the same time, don't be scared to take risks early on with small amounts of money. If you're going to take a risk, you're better off to do it with $500 or $1,000 than do it with $50,000. So the biggest thing is learn from your investments, learn from your mistakes, and do your own research. I keep saying it, but don't just rely on other people to do it for you. All right, I hope that's been interesting to people. As always, if you've enjoyed the video, give it a like, hit that subscribe button, leave a comment on your first share investments. Were they successful? And as always, I'll talk to you on the next video.